Um, it is April 21st, 2025. I hope you all have a great day. Now, what is happening in the crypto markets and Bitcoin in general, or specific, more specifically, yeah. Well, turns out life is a lot like goldfish in a pond. Will you see them? I don't know. Will you be able to catch them if you did see them? If you're trying to catch them? All the opportunities that come before you? Would you be able to get them when you happen upon a big pink blooming flower early in the day? Or will it escape you and return you to your ugliness of your reality? For most people, they're not going to catch the goldfish, and they will quickly return to the ugliness of their reality. Not because they don't have the good intention, but because they will repeat the mistake of missing the occurrence of opportunity. And this happens to even the best intentioned people. There's that old expression, the cats will play when the dog's away. No, it's the mice will play when the cat's away. But I guess the cats could play when the dog's away, depending on the relationship between the cats and the dog. But in the case of cat and mice, it's usually more to the point. So if you look at what happened over the holiday weekend and in the run up to the traditional market open on the CMEs on Sunday night, Sunday afternoon, evening, whatever time it was where you were, Sunday night, Monday morning, depending on if you were far enough ahead in time zones. Right, where the CMEs open. Before that, there was a little run up in the Bitcoin price and on Solana as well, and a bunch of derivatives. Pretty much the crypto market, right, went up a little bit after having descended, a little bit on Sunday. And that was because of the volatility. They had let it down and then back up. And on Sunday, it had been, for the most part, the market had been really going to the upside, also on Friday. So, you want to call it a retracement or whatever. Call it whatever you want. The fact is what it was. It was more buy pressure than sell pressure on Friday and Saturday. And then on Sunday, for most of the day, there was mostly sell pressure. And then it turned around some hours before the CMEs opened. And you got buy pressure again. Bounced around for a little bit batch of volatility. Going up and down, up and down, up and down. And eventually it went to the upside. And has generally stayed on the upside compared to where it was 24 hours ago. But that doesn't mean the people who were longing yesterday didn't lose their positions, right? If they were longing leverage positions and they were down too far, they might have either been liquidated or they might have just stopped out at some point if they were, afraid that it might go down too much further, or they had to, stop trading for whatever reason, right? Like generally speaking, you don't want to be in a trade if you're not at your trading station, right? I mean, sure, you can take your mobile phone with you or whatever, but generally speaking, you want to be trading when you're in front of your trading system, right? If you happen to trade on a mobile phone, well, that's a different story altogether, but it's very risky. But the point is, what we're seeing now, what we're seeing now is You know, you can. I spoke about this yesterday. You can call it seasonality or cyclical cycle. It's not. It's just the VEPs. Okay. It's just the VEPs. There's no patterns. Okay? It's not because it's April. Prices are suddenly going to go up. Okay? Prices go up and down all the time based on the VEPs. Not the time of year. You will fill in a narrative that will tell you it's the time of year. You will fill in a narrative that tells you, oh, the sentiment is high. Yeah, it's ridiculous. Okay? There's just as many people who have a very strong sentiment, if you will, for the prices to go down as there are for the prices to go up. It's roughly 50-50 at all times. And it's a little bit more to one side than the other is what makes all the difference in whether there's more buy pressure or sell pressure on an asset at any given time. Right? But remember, for everyone who's buying, there's someone selling. For everyone who's selling, there's someone buying. Right? It just matters what the spread is on the ask and bid. And at what price do they actually meet in the middle? And eventually there isn't a spread when they agree on the price. Right? So let's say you want $86,500 for a Bitcoin, and someone else is willing to sell it for $86,501. Right? There's a $1 difference. There's a $1 spread between the ask and the bid. Right? But eventually, you might. There's a $1 difference, so there's going to be no sale, right? No sale made, no purchase made, because it's all a difference. But if you're on an exchange, that exchange might say, hey, listen, there's a $1 difference. It's an $86,000 asset, $86,500 asset. What do you care about a dollar? And eventually the person buying it might be like, all right, I'll tell them, I'll meet them halfway. $86,500.50. Maybe the other person, the counterparty, will be like, all right, sure, let's do that. And then you got a deal. Or maybe they'll be like, nah, I'm only going to go down to like $86,500.75. And then there's, some back and forth. And maybe you buy it for that extra quarter, maybe not. If you don't, maybe you wait for the next person to come along and see if they'll sell it to you for the $86,500 flat. Or do you have to negotiate again with them? Right? Eventually, there's no delta. Eventually, when the trade is actually made, because it's an agreed price, right? But the delta that exists, that delta literally, right, is the delta between the ask and bid that causes the standard deviation of returns, right? That's where volatility is born, because you and I will want to buy or sell something, we want to trade something, and we'll have slightly different prices in our heads or on our asking sheet for what we are willing to do business for, what amount we're willing to do business for. That causes the volatility. That causes the returns, right? The standard deviation of returns causes the returns. It does. And this returns are what caused the price action to happen one way or the other, essentially. Price action will do what the standard deviation of returns, in other words, the volatility, or the Laplace distribution of returns, which is just another form of volatility, will say it does according to the correlation of it with the data set. But guess what? So does variance and correlation, because variance is just another word for a spread of data around the mean, which is just another word for volatility. Because what is the spread of data around the mean? It's the ask and bid prices around the mean of returns. So variance is the spread of data. It is the standard deviation, right? The spread, the spread between the ask and bid price is the standard deviation. So variance, once again, is volatility. And you could use a Laplace variance in theory, as opposed to standard deviation variance. And we have all kinds of Laplace tools at Alpha Trading. We've got a Laplace volatility indicator, like we have a standard deviation volatility indicator. We have a Laplace volatility indicator, which is again the same as variance, but just seen differently. We've got Laplace distribution levels, right? Laplace probability projections, called the AT-Wolf forecast. You can see it in Laplace or normal distribution. And there's all kinds of useful Laplace tools that we have. We have pseudo Laplace z-score. Right? You have like a full little suite of Laplace tools. Okay. Anyway, the point is, Bitcoin is moving along very nicely and doing what it does, not because it's April. Okay. It's not. If you look at where it's been so far this month, right? Well, the weekly time frames have been indicating generally what Bitcoin has been doing. The daily time frames have been indicating on the day what Bitcoin has been generally doing. Right? Yesterday we saw Bitcoin looking to the upside, even though it dumped out a lot on the day and then bounced up. Right? But it was looking to the upside. How did the math know from the start of the day? Yeah, this asset's going to go long today. It's going to go up, even though the price was dropping. How did the math know? It's not an accident. If you think it's an accident, you got another thing coming. It is not an accident. Right? The calculators are saying, yep, it's going to go up today. And eventually it went up. It's not an accident. If you think it's an accident, you're ignoring math. Because what happened was plain as day. Right? We saw it plain as day. Plain as these blue flowers in the sunlight. I know, they're purplish more than blue. We saw the assets saying, yeah, today is going to be a day that we drop until we rise. But if you looked only at the daily, you would have seen it's going to go up. And it did go up. But if you looked at the 4 hour, it would have shown you, yeah, we're going down for a little while. And then it turned around. When it turned around very nicely. And this happened across a whole slew of assets. Bitcoin just being one of them. So now that the asset's moving up a little, people who were trying to long it yesterday and got burned because it was going down a bit before it went up, now they might be looking at it today thinking, oh, it says it's going to go up again, but maybe it's just going to go down all day now because it had that nice bounce. Maybe the market will come back today because, yes, the CMEs were open yesterday a little bit on traditional markets, but the real traditional market has not been open since Thursday afternoon, right? Goes for Easter and all that stuff. Good Friday and Easter and whatnot. So maybe the market will come back rip roaring with a vengeance. We'll see. You know what will tell you that? You know what will tell you what's likely to happen as we get close to that time? The actual volatility, the actual entropy, the actual probabilities, and the actual statistics, right? The actual VEPs. Why is that? It's because it's math. Why are the altcoins likely to do what Bitcoin is likely to do? Because they're tied together through massive bots that trade huge baskets of these assets. So yes, you might have outliers, or you might even have pairs that trade pretty much the opposite, almost a lot of the time, or almost all the time, right? Like counter pairs or whatever. And I don't mean stable coins. I mean like two shit coins that trade the opposite of each other. It happens. There's a bunch of those. Some are pretty much by design. Arguably even most are by design. So then you gotta say, okay, well, if we know that certain assets will trade in one direction, generally speaking, and others will trade in the other, can you use that? Yeah, the answer is yeah, you can use that. You can definitely use that. You can even see, right? You can even go on like CoinMarketCap and they'll show you in the asset itself and the information about the asset. It will often show you if it's a coin that has known pairs that trade the similarly, or if they have known pairs or known coins that trade the opposite to it. It'll show that to you, and then you can go look at it on the charts and see for yourself, is it in fact doing the opposite according to the VEPs? And then you can run two trades in two separate directions, one going long, one going short, right? And win both those trades going in opposite directions at the same time. So even if most of the market is going up today, there will be some coins that are going to go down. It happens all the time. Or maybe all of the market will be going up today, or most of it, if not all of it. And the ones that normally go down when the market's going up, they'll go up too, because you'll have outlier events. You'll have geometric Brownian motion, randomness. Right? Happens. Even coins that typically trade in the opposite direction, most of the time, they will have outlier events. Some of the time, that'll make things go unexpectedly. And as a low time frame trader, you need to be aware of that. Now you gotta also keep in mind, on the bigger picture, beyond trading, on the level of the market, like Bitcoin is extremely rare at this point. Not that it hasn't been for a long time, but it is extremely rare, right? Since the beginning of last year, 2024, more than 2 million coins have been purchased by huge institutional firms like ETF issuers, Michael Saylor's company, MicroStrategy, Michael Saylor himself, right, and a whole bunch of other companies around the world, ETF issuers around the world. Did you know that there are Bitcoin ETFs in other countries? Did you know that? There's some in Europe. I think Brazil has one or something. There's a bunch around the world, right? Asia's got, I think Hong Kong has one. They're in multiple places around the world. Sure, they're not as big as the American ETFs, but they are, not unpopular in the sense of people do buy from them in those locations. So there's a dwindling number of available coins. And people will say, well, but there'll always be somebody willing to sell. Yeah, there'll always be somebody willing to sell. But where you had millions of coins, millions and millions of coins generally available a few years ago, on any given day now, you got far less than 1 million coins available. Right? Something like 700,000 or something. Maybe 1 million on a good day. Right? And whenever those coins come on the market, as many of them as possible get bought up by the likes of companies like Strategy and these ETF companies, other ones. Why? Because they don't want you to have any. They want it all. They already have more than 90% of it, the whales, right? Of the max supply. And they really have more than 95% of the circulating supply. And when you consider that, the remaining, like, whatever tiny percent less there is to be mined, what's left to be mined is already less than what MicroStrategy already owns, right? Pretty much, or close to it. They got 500,000. Okay, so there's still more than that. But if you add up MicroStrategy, Michael Saylor's personal stack, and Satoshi, that's pretty much what there is left to be mined. Obviously, there's a bit more, but not much. Right? There's more than 19 million already mined. There's only 21 million Bitcoin going to be ever mined. That's going to take another 120 years to mine the rest of it. 115 years, whatever. Which means we're now at the point already. Even though you can still get more than one Bitcoin if you mine, you can still get more than one Bitcoin. Each time you mine a block, you get a few Bitcoin still. But like in another halving, we'll be down to 1 and change. And then after that, that's it. We'll be sub 1 Bitcoin for every block mined. So just keep that in mind. It's a very rare substance, a very rare thing. And people say it has no use, it's only good for store of value, it's not a good network. But the reality is, it is very useful. It's extremely useful. For all kinds of useful transactions. Anyway, that's a different debate for a different discussion, different topic. For now, I will just tell you, if you want to come and learn how to trade the BEPS, come to the Alpha Trading Discord at alphatradinghq.com/discord. Again, that's alphatradinghq.com/discord. We do live streams Monday through Saturday, starting at 11 a.m. Eastern Time. And we stream them out to Rumble, so if you missed the live stream, or if you just want to watch on Rumble, you can do that. Okay. That's it for now. Take care, folks. Happy trading. Peace.